Eurozone debt crisis could leave us in a crude awakening. The commodity fell for the first time in 3 days today after Egan-Jones downgraded Spain's credit. But just how much are European debt woes driving demand for crude? You wouldn't think they're necessarily related, but guess what? They are. And in today's next big trade, Francisco Blanch, head of global commodity research at Bank of America Merrill Lynch, joins us with 4 possible Eurozone scenarios and, of course, how to play them. Francisco, great having you. So why don't you just sort of outline for viewers your 4 scenarios and what that means for crude markets?
Sure. Look, I think there are basically 4 potential scenarios here. As you highlighted it, under scenario number 1, there is a swift resolution to the ongoing woes in Greece, some of what's going on in the banking sector in Spain, and oil prices rebound towards that $115, $120 range scenario. I'm talking about Brent specifically here. WTI is a bit more disconnected, a bit more regional to the U.S. Midwest markets. But, Brent really goes straight back where we saw it earlier in the year. Under a scenario where we keep on talking about a Greek Eurozone exit, we see $100 a barrel for Brent. WTI could drop as low as $80, $85 a barrel. Again, but this is if that scenario doesn't materialize. So we could continue to roll lower here over the next few weeks just based on that Greek scenario, that Greek fear alone. Now, if Greece does leave the Eurozone, we do see $80 Brent, potentially $60, $65 a barrel WTI. Again, we're talking about a scenario where Greece leaves the Eurozone within a month or 2. Not a very likely scenario, or not the most likely scenario, but certainly a potential risk to the market. If that was compounded under our scenario number 4, with bank runs in Europe and literally a lack of ability to contain contagion, we could see Brent as low as $60 a barrel. And I think this is a real risk that the market is trying to understand, but it's there.
Francisco, what is the most plausible scenario in your view? What are you preparing for?
Well, we think maybe there's a little bit of downside risk here on markets. And again, I'm not just talking about oil specifically. I also run asset allocation research, so we do believe there's
a little bit of downside for markets. What does that mean, though? When you go through scenarios 1, 2, 3, and 4, 4 being the worst, with bank runs and Greece exiting the Eurozone, total catastrophe, 1 being a swift resolution, where do you see this coming out?
I think the most likely scenario is scenario number 2. We continue to see a lot of pressure on markets. Greece doesn't leave the euro in the end, but we get pretty close to it. And then ultimately there is Fed QE in the second half of the year. There is another intervention by the European Central Bank to stabilize markets, and that gets you back up to $115, $120 Brent range later in the year.
So Francisco,
that's the core scenario, really.
It sounds like we're getting pretty close to your target. In other words, you had said, if I heard you correctly, Brent $100 and WTI 85. WTI is around 90. So it sounds to me like another $5 a downside, and you would probably be a buyer of oil. Is that right?
I think so. I think it needs to get worse before it gets better. Again, it's not just oil here. We're talking about all risk assets, which are highly interconnected right now in this crisis. So we are pretty much holding on to every word that politicians say, that policymakers say, because it's so important with regards to the future value of risk assets. So in that sense, oil is being driven by that very same mood. So yes, my initial expectation is that we are going to see a response by the policymakers within the next 2 or 3 weeks. The funding pressures in places like Spain are already very, very high. The Greek election is literally 2 weeks away. So this is all coming together in the next sort of 2 or 3 weeks, really.
We had Jeremy Siegel on, Professor Siegel from Wharton earlier, and he and Jason Trennert, our guest host here, were talking about the need for Europe to step in and backstop all these losses and prevent these bank runs with an FDIC-like facility. Do you see Europe going that far?
Look, there are 2 things that will make me very comfortable owning oil and owning risk assets more generally. Is number 1, if Europe creates a Federal Deposit Insurance Corporation look-alike for the Eurozone, that will prevent bank runs across the Eurozone, and that I think is essential to fight the next crisis in the European in the European markets. The second thing that will get me very comfortable is if European banks start to draw upon the European Stability Mechanism or the European Financial Stability Facility to fund themselves. Because right now, the burden of funding the banks is falling on national governments. If that is the case, I think that sovereign finances are going to get even more strained, and we're seeing that on the 10-year sovereign bond in Spain. So in my mind, those are the two key elements. Is one, can we see the European taxpayer being held accountable for refinancing banks in different countries in the Eurozone? Yeah. And number two, are we getting that federal deposit
insurance? Sounds like bottom line, we're talking about shorting oil here, though, because
well,
even
but only
in
for
your,
$5.
Even in, $80, isn't that your level that you could foresee it going to in the number two scenario, which you think is the most likely to play out?
Right. I mean, exactly. I mean, I think before we get to that, before we get to European leaders being forced to take those actions, they're going to have to see more pain in markets. Look, the Spanish 10-year bond is trading at 640. In terms of yield, that is pretty close to the levels where Portugal, where Ireland, where Greece went on to their rescue, to their IMF programs. So we are not that far off from a decision point for policymakers in Europe. I mean, they cannot wait more than 2 or 3 weeks to make some key decisions. So, and I think they're going to make the right choice. I think that politics are going to stay rational longer than countries will stay solvent.
All right, Francesco Blanch.